Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, Trump's vow to tariff 8 European nations over Greenland purchase demand sends STOXX X600 plunging 2.7%. So we'll discuss why using tariffs for territorial acquisition is shaking the NATO alliance and what it means for European market stability. Second, Trump's move to fire Fed Governor Lisa Cook escalates to the Supreme Court, challenging the central bank's political independence. We'll examine how this challenge to the Fed's autonomy may impact the independence premium on US, debt, and global market stability. Third, China blocks Nvidia's H200 AI chip, freezing 1 million orders and threatening to slash its market share from 66% to 8%. In this episode, we'll break down China's sudden rejection of the custom-designed chip and what it signals for Nvidia's future and the tech supply chain. A geopolitical bombshell just dropped. Donald Trump has vowed to impose escalating tariffs on 8 major European nations for one reason. He wants the United States to buy Greenland. At the heart of this is a major escalation in the global competition for Arctic resources. President Trump's focus on Greenland's mineral wealth is directly tied to a strategic US push to secure what are known as critical minerals, things like rare earth elements or REEs, which are vital for everything from smartphones to defense technology. The US strategy is shifting from simply having influence in the region to outright acquisition, which could intensify resource-driven conflict between the US, Russia, and China. The threat announced on Truth Social is not subtle. It outlines a 10% tariff starting February 1st on goods from Denmark, Norway, Sweden, France, Germany, the Netherlands, Finland, and Great Britain. Those tariffs will then escalate to a staggering 25% on June 1st and will continue until a deal is reached for the purchase. The response from Europe was swift and sharp. Denmark's foreign minister called the announcement a surprise, but other leaders were more direct. The Swedish Prime Minister fired back, stating, "We will not let ourselves be blackmailed." And, the markets reacted even faster than the politicians. Financial markets hate this kind of uncertainty. In fact, following the announcement, the pan-European STOXX X600 stock index fell 2.7%, its biggest single-day drop in 8 months. It's a clear sign that investors are immediately pricing in what experts call a geopolitical risk premium. They are demanding higher returns to compensate for the brand new risk that economic tools like tariffs could be used for territorial goals, which destabilizes the entire NATO alliance from within. This isn't just a war of words. In a move showing a coordinated front, European nations have already sent military personnel to Greenland at Denmark's request. The core conflict is a direct power struggle. Trump insists Greenland is vital for US security and its mineral wealth. European leaders warn that a US move on a NATO territory could collapse the entire military alliance. This internal conflict in the West presents a fascinating duality. On one side, it's a messy power struggle, but on the other, it inadvertently strengthens China's position in global trade and technology. A divided West is simply less effective at presenting a united front on key issues related to Chinese industrial policy. But that's not the whole picture. The real turning point is that the very legality of these tariff powers is hanging by a thread, with the US Supreme Court currently reviewing the issue. The president is using a law from 1977, the International Emergency Economic Powers Act, or IEEPA. However, lower courts have recently ruled against this, stating that the president overstepped his legal authority. So the Supreme Court's upcoming decision is a huge deal because the current legal ambiguity acts like a tax on capital. It freezes long-term decisions. Multinational corporations in sectors like automotive and manufacturing are delaying major investments and supply chain adjustments until the Supreme Court provides a clear answer. This has now escalated far beyond a diplomatic spat. It's a high-stakes standoff with billions in trade, existing deals, and a core military alliance hanging in the balance, all triggered by the unprecedented demand for the sale of a country. Looking ahead, 3 things are critical. First, all eyes are on the Supreme Court. Their ruling will define the limits of presidential power in trade for years to come. Second, watch how the European Union responds. Will they maintain a united front, or will this tactic lead to fragmentation? And third, watch the financial markets. In the short term, this uncertainty will likely cause a flight to safety, benefiting assets like US Treasury bonds, while putting downward pressure on European stocks and the euro. Speaking of the Supreme Court being thrust into the center of economic policy, another high-stakes battle involving former President Trump has just landed on their doorstep. He's attempting to fire a sitting Federal Reserve Governor, Lisa Cook, a move that challenges the very foundation of the central bank's independence. For decades, global financial markets have operated on the assumption that the US Federal Reserve is politically independent. This belief gives investors confidence that the Fed will prioritize long-term economic stability, specifically controlling inflation over short-term political goals. This confidence creates what economists call an independence premium. Because the world trusts the Fed, the US government can borrow money at lower interest rates. If that trust is broken, this premium vanishes. Cook has fired back, calling the allegations against her a pretext to remove her for her monetary policy stance, and this conflict goes deeper. In a stunning escalation, Fed Chair Jerome Powell himself has stated that a criminal investigation launched against him by Trump's Justice Department is also a pretext designed to gain more influence over the central bank. Here's where it gets interesting. This internal pressure can paralyze the Fed's decision-making process. The Fed's main policy committee, the FOMC, relies on consensus. But if governors feel they are under political threat, agreement becomes much harder. We are already seeing signs of this. The Fed's own dot plot, which shows where each member thinks interest rates should go, reveals a growing divide. In the latest release, the number of members expecting no rate cuts this year nearly doubled. Layer on top of that, the voting rotation this year bringing in more hawkish regional bank presidents, and the bar for rate cuts gets even higher, intensifying the split. This all happens as critics warn these moves are a bid to pressure the Fed into lowering interest rates ahead of the November midterm elections. The fear is that if investors and the public believe the White House can force the Fed to keep interest rates artificially low, they will start expecting higher inflation. And those expectations can become a self-fulfilling prophecy. To compensate for this new inflation risk, investors will demand higher interest rates on US government bonds. This isn't just a problem for the government. This sovereign risk premium would ripple through the entire economy, leading to higher mortgage rates and more expensive car loans. Now, all eyes are on the Supreme Court. While the court has a 6-3 conservative majority, a clear line in the sand may be drawn here. Legal experts point to the court's own past writings, where the justices sought to protect the Fed, calling it a uniquely structured entity. The court has previously allowed Trump to remove officials from other agencies, but signaled the Federal Reserve was different. The case hinges on the specific legal language in the Federal Reserve Act, which says a governor can only be removed for cause. Historically, this has been interpreted very narrowly. The Supreme Court's job now is to decide if disagreeing with the president's economic policies qualifies as cause. A broad interpretation by the court, allowing the president more power, could trigger immediate volatility in interest rate markets as traders try to price in this new political risk. This is no longer just a legal dispute over one official's job. It's a direct test of the limits of presidential authority over the nation's economy. The Supreme Court's ruling, expected by the end of June, will deliver a landmark decision. Beyond the court's decision, it's crucial to watch how foreign central banks react. A politically compromised Fed could accelerate a trend that's already underway: global diversification away from US dollar assets. Data from the IMF already shows a slow but steady decline in the dollar's share of global reserves. If confidence in the Fed wavers, the exorbitant privilege the US enjoys from the dollar's dominance could begin to erode. For a country like China, this could be seen as an opportunity to further promote the international use of the renminbi. We were just talking about China's opportunity in the financial sphere, but in the world of technology, Beijing is making a much more aggressive move. Production lines for Nvidia's brand new H200 AI chip have just ground to a halt. The reason? Chinese customs officials have blocked all shipments of the processor from entering the country. The story begins with a decision that caught everyone by surprise. China rejected a chip that was tailor-made for its own market. The H200 was Nvidia's so-called Goldilocks chip, designed to be just powerful enough for Chinese customers without violating US export controls. So, for China to reject it, it signals a major strategic shift. Nvidia's entire strategy of trying to thread the needle between Washington's rules and Beijing's demand has just been invalidated. This isn't a small disruption. Nvidia was reportedly expecting more than 1 million orders for this single chip. Now, that entire operation is frozen. This sudden stop creates what economists call the bullwhip effect. A small flick of the wrist creates a huge crack at the end of a whip. Similarly, a sudden halt in orders for a product like the H200 sends massive shockwaves backward through the supply chain. Key component suppliers such as TSMC and SK Hynix are hit the hardest. For context, high-performance computing, which includes AI chips, accounts for a staggering 60% of TSMC's revenue. This halt exposes just how fragile this incredibly complex supply chain is to geopolitical risk. This is where the situation takes a more complex turn. Sources indicate this isn't just a customs issue. Government officials in China also reportedly summoned domestic tech firms, warning them not to purchase the chips unless absolutely necessary. The H200, Nvidia's second most powerful AI chip, is now at the center of a major geopolitical flashpoint. Now, get this. The warning to domestic firms suggests this could be a high-stakes stress test for China's own AI chip industry, aiming to accelerate the move toward technological self-sufficiency. And there's evidence they feel ready. Research shows that Huawei's latest Ascend 910C chip is closing the gap. While it's still about 24% behind the H200 in raw performance, Huawei has demonstrated that through system-level integration, it can achieve competitive results. Though the trade-off is much higher energy consumption, it proves a viable non-Nvidia alternative now exists. Interestingly enough, authorities have reportedly given no official reason for the directive, leaving the market to guess. This ambiguity is almost certainly by design. This kind of move fits a pattern of what experts call economic statecraft. While China has formal tools like the unreliable entity list, the ambiguous nature of the bloc allows it to be used as a powerful bargaining chip in future talks with Washington. The resolution of this will be a key barometer for US-China relations. This move leaves over 1 million orders in limbo and forces suppliers to shut down production indefinitely. The immediate fallout is a massive order book now hanging in the balance, forcing a material reassessment of Nvidia's future. The Chinese market is a huge source of revenue. Some analysts are now projecting that because of these restrictions and the rise of homegrown competitors, Nvidia's share of China's AI processor market could plummet from 66% in 2024 to just 8% by 2026. This fundamentally changes the growth story for one of the world's most valuable companies. The key focal points to watch now are any official announcements from China's Ministry of Commerce and, critically, how well domestic chips from companies like Huawei perform as they are forced into the spotlight.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.